SuperAI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that all in one place in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world.
Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together.
Hey everyone, welcome to The Journeyman, which is my exploration of that journey to the nexus of macro, crypto, and the exponential age of technology. Now, serendipitously, it's a live show today with Jamie Coutts. Jamie is the chief crypto analyst at Real Vision and one of my go-to people in the entire space. And we get to shoot the shit on a day like today and hopefully give you an idea of what actually is going on, because I know people are freaking out about the tariffs, freaking out about market price action. And today is a perfect day to bring on Jamie. Hello, mate. How are you?
G'day, Raoul. Nice to see you again, man.
Nice to see you. I know you were up early because I was getting messages from you some God only hour.
Yeah, well, it seems to be the pattern these days. Love living in Australia and doing all my calls suited to North American and European audiences.
Yeah, and then the evening sessions of drinks in Australia, so you just don't get a chance to sleep anymore. But you've got a baby, so you don't sleep anyway.
Yeah, no, well, exactly. And it's only going to get worse in the next year or so.
Yeah, exactly right. So how I'm thinking about this, and we'll talk about what your framework is and what you're thinking. Now, Jamie's work, for those of you who don't know, is on Real Vision Pro, but he appears all over Real Vision. He's part of the big Real Vision community in Australia, which is our biggest communities in the world, and is a very active member in all of our crypto communities overall. So, Jamie, how I'm thinking about what's going on now is, I know the talk is tariffs. I know it's all about what's happening today, what happened yesterday, what did Trump announce? But I go back to the framework that I've been using, which is liquidity. And the liquidity has led this whole price action by 3 months so perfectly. It's been sort of insane. And, I'm just, Peter, I'm just going to share a chart. This is from Global Macro Investor, just to kick us off on how I'm looking at this. Now, this doesn't have today's price action, but again, price action in Bitcoin is actually not that bad today, not like the Nasdaq's getting nuked. And I'll talk about the Nasdaq in a sec as well. So global M2 versus Bitcoin, either a 10-week lead or a 12-week lead, doesn't really matter. But basically, should be the bottoming zone. What is happening here is there's a reaction to the Trump headlines, yes, of course, but a lot of this was baked in the cake because of liquidity tightening by the rising dollar and rising rates last year. Now, you can see from the black line, which is forward-looking, 10 weeks, and this doesn't take into account the current move in the dollar and rates and oil, is actually financial conditions are easing really, really fast. The Nasdaq is all the same as well. You can see from the chart here, we're kind of in the bottoming zone. Forward, we've got global M2. And the financial conditions index is screaming higher, whilst the economic surprises index of how the economic activity is versus expectation should start raising too. So the growth shock has largely been put in the price. I think I've got somewhere here some of the charts of the growth shock itself. I'm just trying to flick through. So yes, that's the financial conditions index. Bitcoin, 3-month percentage rate of change, has actually priced in all of the tightening of financial conditions and should very soon start pricing in the other side, which is this financial conditions easing. Now, this will be much higher again because of the last few days. So for me, it's kind of expected. The last time you came on, Jamie, was pretty much at the tail end of a panic back in September last year. at the end of that god-awful range. Nobody believed we'd ever get out of it. You came on and said, I think we're all going to be fine. I was of the same, and it all figured out. So lay it on me. Where are you in this?
Yeah, well, I mean, we both have our own hypothesis about what drives markets, and then we build frameworks around it. And obviously, your framework has informed a lot of what I do and how I think as well. But I created my specific macro framework based on the inputs that I saw and backtesting. And you build these, well, personally, I build these frameworks because I'm trying to eliminate a lot of the subjective bias that creeps in when you're investing to try and reduce errors. And my models are also saying that financial conditions as of starting in February and then accelerating into March, mid-March, all started to pick up and gave me the signal that Bitcoin should do very well over the next, over the foreseeable future, 3 months, 6 months, 12 months.
Yeah.
I couldn't predict what the Trump administration was going to do with tariffs, especially that formula that they've applied. I think that has caught everyone by surprise, even those that expected Trump to perhaps surprise on the upside. And so even with that, you now get so much more pressure on the Federal Reserve to act. And with that, we know typically asset prices respond quickly. And so it does seem like this is a growth shock that will be met with a requisite amount of stimulus. And that typically is very, very bullish for risk assets. And what's interesting is that Bitcoin, is 3 times the vol of the S&P, maybe about 2 times NASDAQ or 2.5 times NASDAQ. The price action over the last week and a half, maybe even longer, has been surprising given the moves that we've seen in other risk assets. So, of course, if things crater, if something else happens, if there is a geopolitical blow-up or if there is other things which we can't foresee, then all bets are off. But that just accelerates, again, the response that will be required from central banks. It's like I describe it as investing in Bitcoin specifically, not just crypto, but like Bitcoin is like playing chicken with central banks. Yes. Because you know what they know and they will need to do something sooner or later. And so it's whether you can stomach the volatility that comes with this asset on the way to the overall trajectory, which is liquidity up.
And, that just so people are aware, financial conditions, different people measure it different ways, but one of the easiest ways is, an amalgamation of rates, the dollar, and some commodity prices, input prices. And we've seen a massive move in oil. We've seen a massive move in rates. They formed a nice head and shoulders top. Looks like, we should see rates back down at 3.5% in 10 years. And we've seen an enormous move in the dollar as well. It's a gigantic move in the dollar. And the dollar is the big daddy of all liquidity measures because everybody's in debt dollars. And I said this from the beginning is like China needs a weaker dollar. They will agree tariffs in the end, whatever the negotiation is. They'll agree something because they need the weaker dollar because they need to roll their dollar debts. Everybody needs to export goods and you need a weak dollar to have a stronger global economy. The US needs to export stuff. Everybody wants a weaker dollar. And the weaker dollar is the biggest stimulus you can get. So it kind of is all, for me, it's like it's setting up. And now it's about technicals and on-chain stuff and just trying to nail the timing. Because we've both identified it's like next 3 months, for sure higher. There'll be consolidations. Next 6 months, probably next 12 months. That's kind of how it feels. Pretty certain. Now, the question is whether it's next month higher, which I actually think, we probably end up, higher within 2 weeks' time than we are today, put it that way. I don't know. So how are you thinking about, let's kind of zoom into your framework, I guess, in a bit more detail, because you've probably got a bunch of charts to show and other bits and pieces.
Yeah, I'd say, when I looked at the DXY back a couple of weeks ago and saw that massive move down, which was a 3-day consecutive move of more than 2.5%, which was in fact like a 2.5 standard deviation, 3 standard deviation event. every single time that had happened in the past, over the next 90 days, Bitcoin was higher and substantially higher. I've actually got a chart around that as well.
Yeah.
So I might just bring that up. But so you can see that on your screen now. So this is just the Bitcoin chart with these large DXY moves that occur over time. And the subchart is just showing you the percentage change. But when you look at what happens over the following 90 days, and there's only been 8 of these in the last sort of 12 years. So sample size is relatively small. So take of that what you will, statistical significance, from a purist standpoint might not be there, but at least we've got over 12 years, 8 occurrences every single time Bitcoin is up substantially. And this yellow line here is just the average of all of those 8 instances. Now we can see where we are today. We're right at the bottom. This is the worst performance post that signal of the previous 8 signals that we've seen over the last 12 years, but pretty much in line with what happened in 2015. On average, though, Bitcoin is up 37% 90 days later, and one standard deviation move above that is 63%. So that really brings us towards 120, 130,000 if it's just an average move. And if it's something more, then, it's actually probably about 110, 115,000. But if it's a one standard deviation move higher,
but new highs.
Yeah, it's new highs. And so that was giving me a lot of, confidence when we started to see that big dollar move 2 or 3 weeks ago. But since then, it's actually depreciated a lot more. So I think that that really does set up for a strong move. Now, the problem that we have just in the short term, Raoul, I think, is around tax loss or tax season in the United States. And if anyone's looking at their crypto portfolio right now and they've bought in the last 6 months, they're on tax losses. So they might actually dampen things down. The other, counterpoint to that is I think FTX reimbursements are starting to flow or will be flowing very soon. So how that gets recycled back into the market will be very, very interesting. I think Bitcoin will catch a bid first with people who get some sort of recovery money from FTX. And so that may offset sort of the tax loss selling that we typically see around this time.
So what other charts do you want to show us, Jamie, before we dig into some stuff? What are you looking at? Your ideas right now.
Sort of my favorite chart is just looking at the global liquidity, the total global liquidity, which is slightly different to yours. But the interesting thing here, if we just look at the last couple of days, is that we are very close to breaking out of a contraction in total global liquidity, which is obviously an aggregation of...
that's a beautiful kind of wedge pattern, right?
It is, and we've seen it happen, on several occasions before. So this drawdown if you can call it a drawdown, like global liquidity, when global liquidity contracts, at least in Bitcoin's history since sort of 2009, the contractions have only been about 5%, and they've lasted 2 years, at least on the previous 2 examples. This time around, it was 10%, and we're still in the consolidation or wedge pattern, and it's 3 years. So it's been deeper and longer than previous times. And so, just from technical analysis, when you get a wedge pattern that's even larger and goes on for longer, usually the breakout is even stronger. So, and we know that this is an upward moving chart. It has to, because essentially it's the only way the financial system can stay afloat.
And so global liquidity means that a lot of it's going to be driven by the dollar, which is now trending lower. And if it breaks kind of the 100 level, it can move down to, in DXY, it can break, it can move down to 90 or so, which would be, a good cyclical dollar bear market in a structural dollar bull. Then we've got the central banks and others, and that's driven probably by China, the US, and others, I'm guessing, using other liquidity measures within that. So, China's probably the big one in that. But yeah, well, that's your global money supply.
Well, yeah. So I mean, this is actually just this is the global money supply versus blockchain addresses or active addresses. And so, no matter what you look at in terms of like fundamental metrics in crypto, it all maps to liquidity. So activity, price, they're all pretty much the same thing. They're intertwined, and they react to changes or impulses in global liquidity. And what's interesting is that, again, we've only got 5 years of this data set to really use, because this is tracking smart contract platforms, active addresses, right? And we've only really, Ethereum came on the scene in 2016, but it wasn't until 2019, 2020 that we started to see alternative layer ones. But if we look at the number, you can see that smart contract platforms actually lag usually global liquidity. And the last time we saw such a massive divergence between increasing global liquidity and smart contract active addresses was really in 2019. And by 2020, it caught up pretty aggressively. So if we have the view that global liquidity is about to expand and expand dramatically, which is a certain bet at this point, then we will see activity flow back into the crypto economy. We will see a massive uptick in stablecoin usage, and even a return to some of the more speculative elements of the crypto ecosystem eventually. So it's really just sort of conveying the same thing in a different way of just overlaying the price versus liquidity, or we're looking at actual activity in the space.
The other thing that I think is on the cards at some point soon is, I'm just going to share a chart here, is Bitcoin dominance. Bitcoin has been dominant. It was dominant all up until this point in the prior cycles in 2017 and also in 21. It stays dominant much longer than everybody expects, and then it tops. And this is the monthly DeMark, and we put in a 13 top. And if I switch that to the daily now, we are getting very close to having a 9.13.9 top. That'll be 2 days away, which would match to me with the 9.13.13.9 on Solana as a bottom. There's a lot of things that are getting close to saying the liquidity cowbell is coming, and the structure of the market may well change with it and usher in the next phase. What I talk about, the second phase of the banana zone, which is really often alt season starts at this point. How are you thinking about the evolution of the market going forwards from here?
Yeah, look, I mean, I love when you bring up DeMark, because it's a tool that I don't get access to. But it's also there's a lot of learning behind it too. You can't just pick up DeMark and just sort of run with it. There's real rigor in how to implement it too. But it's interesting because it's the mirror image of what I'm looking at with my breadth indicators. So I don't know if we can bring up this chart here, but as you know, for our Real Vision subscribers, I partnered with an index provider called Bitformance to provide crypto indices and sector data to all of the RV subscribers. In fact, we've now delivered the first dashboard inside the Real Vision platform, which
that's
now
on Real Vision Plus, right?
I believe
on the data center, correct? Yeah.
Data center. If you navigate to data center, there is now a new tab called Crypto Dashboard. In fact, we could show this actually.
Yeah, show that.
Bring it up.
There's a lot of work gone into this, and it's really cool.
Yeah, so it actually has been. We've launched it, but there hasn't been much fanfare. Like, we have not actually gone out and done a proper marketing video around it. But look, let's just show everyone today what it looks like. So the left-hand toolbar, you can see under the data center section that there is now a new tab called Crypto Dashboard. And so if you click in here, what it will provide is now sector level information. I think this is absolutely critical. I come from traditional markets, equities. You have a Bloomberg. Everyone in the space breaks down the market, or has market composition frameworks for looking at things, whether it's through the sectors and subsectors. Crypto has been lacking that for the longest time. Now, I helped develop the Bloomberg version of this, but Bloomberg, in their wisdom, really haven't followed through. And in the meantime, S&P and various other index providers are stepping into the space. That's all well and good, because that just means ETF providers can create products around this, and that's great for everyone. What retail needs is an equivalent. So this is effectively what that is. And you can see the performance across all the different sectors here. And if you break down the sectors into subsectors, you can really drill in under the hood and see which subsectors are taking the biggest hit, as it turns out right now, because the market's off. But we've also got a top 200 market cap index and a top 200 equal weight index. And that was the chart that I was going to show you, because when you compare these two different indices and their weighting regimes, you get a pretty good indication of breadth. And it won't surprise everyone to know that the market cap index has been outperforming the equal cap weighted index. Why is that? Because Bitcoin is about 60 to 70% of the total of the top 200 itself. And there's been some other large caps that have actually done fairly well, like the Dino coins and even Binance or Binance Smart Chain. But the point being is that it has not paid to be out the risk curve in crypto, really, for all of this cyclical bull market.
Yeah, there's been, as you said, there's been some outperformers, but the market itself has not outperformed.
It's been really tough. It's been really tough. And that ratio chart that I was showing is market cap divided by equal weight indices. And so we are.
Does that go back to 2017, Jamie? Or was it only start at 18?
It starts in 18. Oh no,
we've got data going back. So you 17. See, if I think about the crypto years, year 4 of the cycle being this year 4 of the cycle was 2017. Look what happened. Year 4 of the cycle was 2021. Look what happened. Year 4 of the cycle, we're coming in at the low, exactly as we did every time. It's interesting.
Yeah. The data's a bit patchy in that sort of 2 cycles prior.
Yeah.
But you can see here that there was a huge uptick in the sort of Q4 period as we went into ICO season and all the mania that happened right at the end of that bull market. And then the big move in the 2020, 2021 market started at the
Does it go back? Sorry, does it go back earlier in 2017?
No, it starts sort of at...
Okay, because it actually did come from much lower low. So we had 2 legs to the alts run.
That's right. Yeah, absolutely. I don't even think that the index was capturing the top 200 back then. So it's sort of evolved over time.
Yeah.
But I guess the most direct corollary is the 2020, 2021 market, because the data is just a little bit better. And it was at the end of sort of 2020 that actually we saw that altcoin rally and outperformance. Now, in the last couple of years, well, in this cyclical bull market, we've seen 2 periods where altcoins have outperformed. It was the end of 2023, and that lasted for 6 months into Q1 of 2024. Then it rolled over again, and we saw into Q4 of last year a big move up. And I was talking about this actually at that point. I was writing research around sort of the breadth being extreme at this point. And we did get that rally, but obviously since then it's rolled back over. I think we're at another extreme right now in terms of sentiment, where altcoins or the equal weighted index is severely underperforming and due for a recovery.
If you think through, there's either the cyclical moves within the longer term downtrend of Bitcoin being more dominant, but then there's these larger cyclical patterns of a much larger reset that happens as alts then play the catch up. Do you think we're going to get that? Or do you think it's going to be more like the other cyclical patterns we've had? Do we get a full altcoin season or a partial?
I think there'll definitely be at least one more breadth thrust from altcoins. The question is it a sustained rally that we see for 6 to 12 months? At this stage, I'm not too sure, but I do believe that quality altcoins, where activity returns and activity drives prices, and we just saw the previous chart where liquidity drives activity, then we'll definitely see a recovery in some of these little more high quality names. And so the high quality names are, if you can just track where network activity is gravitating and use that as your sort of North Star for how to trade or how to invest in crypto, then they should really start to perform at some point in the cycle. So I'm expecting really by sort of June, we'll start to see altcoins start to pick up again, predicated on the fact that Bitcoin is back at all-time highs by that point.
What about new highs and lows and stuff like that? I think you've got a tab up there of it. What are the ways of looking at breadth to say, okay, we're looking towards a reversal pattern? What are the signals you're looking for?
Yeah, and this is again like only possible when you have an index provider data, because this actually allows you to perform historical comparisons with a data set that's survivorship bias free, which is a really important thing. And so this 1 year low indicator, I kind of use as my capitulation indicator. We saw in the bear market, this number on the right-hand side represents the percentage of assets in the top 200 that are hitting 1 year lows. And you can see that, bottoms in a bear market are a process that lasts many, many months. And so you'll see this indicator spike above 50% on several occasions. If we are in a cyclical bull market, capitulation, just thinking about it from a equities framework, because of the volatility of crypto, if you sort of translate what you typically see in equities into crypto, adjusted for the volatility, I believe that around a 50% reading on this indicator is a capitulation indicator or a capitulation event. And we got that actually, it hit like 48% mid-March. Now, interesting as we're testing these lows now in this current sell-off, that we haven't seen a reading as high, but look, anything can happen in the next couple of days as this sort of washes out.
But we've typically seen that pattern before. You get a big spike and then lower spikes as the market starts to then recover, right?
Yeah, so those sorts of divergences are very indicative of a looming recovery. And we did see that in the last pullback. So if you go back to mid or Q3 of 2024, as the market was probing lower into sort of September, you can see that actually the worst was behind it. That low back in August with the reading of sort of like 21% was never matched again. So actually the breadth was improving underneath the surface. Even though prices were sort of down, the breadth was actually improving. And they're the sort of things that, ultimately you want to look for. So you only know that after the fact, by a couple of weeks, as prices recover and you start to look back and see, okay, well, we saw, in the case of the capitulation indicator, much lower readings on new lows as the price sort of probed lower. And then we start to see a bit of a recovery in price. And that's really your indicator that, okay, I think the worst is behind us.
So what else are you building up in your kind of toolbox of things you're looking at to say, okay, we're getting closer to the low? Because I think this is what people are super focused on, right?
Yeah, well, I think those two things are, looking at where capitulation is taking place. So new lows, and also the relationship between small caps and large cap cryptos, which are back at levels that we saw in 2020 when the market started to rip higher. Everything has to be put in context of like what's happening on the liquidity side. So when you look at the on-chain data, and I put this into a report that went out last week, was that if you look at on-chain data only, it's telling you Bitcoin bet that the Bitcoin bull market is over. Right? So all the on-chain, the network activity readings, the network profitability.
Have you got a way of showing that?
I do. If you just give me a second, I've got actually a slide deck here which I can show.
Yeah, because that's quite a statement to say, one set of your indicators say it's all over.
Well, okay, so if we have a look at something that was published by Crypto Quant, which is the Bitcoin data provider that I use. Let's see if I can bring this up on a clearer screen. Okay, so this is their bull score. Now, the bull score is comprised of a aggregate of on-chain metrics, and which makes sense. I mean, they are an on-chain data provider. They don't factor in anything to do with macro or liquidity. And so the bull score for Bitcoin has dropped to around 20. The last time it did that from being at 100 was really the May 2021 correction. And so you're left assuming that, okay, this is just like May 2021. The problem with that in May 2021 was that we were 13, 14, 15 months into a massive liquidity expansion, which had already moved prices substantially higher. By that stage,
Lost your sound, Jamie.
oh,
There you go, you're back.
yeah. So I was just saying that there is a lack of context with using on-chain data alone because it doesn't factor in liquidity. And so when the last time the bull score dropped like this was back in mid 2021, but that was at least sort of 12 months to 15 months after the massive liquidity expansion that we saw in the response to COVID. Now it's dropping just as liquidity is about to expand after a 3-year contraction. So there's just yeah. So I pointed that out in the research.
And what about technical wise? Are you getting anywhere technically that is interesting from you? And I've got DeMark, so I'm just going to share with you something in a quick sec, just to flip charts around. So here's Solana weekly again, 9, 13, 9. That was the top. We're counting down to the weekly 9, which should come in any day next week. So it tells us a potential low. When I look at the daily, this brutal collapse from 280 something back down to 115. Again, we're now at a 7 count, would give us another 2 days. We would have a 9, 13, 9 bottom. So we're really starting to set up in many of these. I think Sui on a weekly as well was a perfect 9 signal. We're now looking where we might be in this is the daily. We're on a 10 of 13 and a 6 of a 9. So it kind of feels so close to me that we're at the capitulation time that you and I spoke last time back in September. You know, and the forward-looking liquidity stuff looks good.
Yeah, so I think for the leaders of the crypto ecosystem like Solana, that looks to me like if now we see the response from central banks and liquidity starting to pick up, you've got a false break below a very important support level. And typically when you see a false break, the reaction to the upside is pretty dramatic because it always catches people offside who get very, very short right into the bottom end of that range. So that's, I think, with Solana and a couple of the large caps like Sui. There's been so much destruction in like the DeFi space. Like if you look at DeFi charts, they have broken through the 1-year lows. And so they're just in free fall, right? Whereas Solana...
And that would make sense because on-chain activity has been so low.
They are hypersensitive to the change in on-chain activity, and they're higher beta. So they get sold first. And so I think that like for them, the leadership will come from Bitcoin first, Solana, even Ethereum, and then it will flow through into some of the DeFi assets, which, I mean, just from a fundamental standpoint, they are looking increasingly attractive. It's just that the price action right now is shocking. And so I've been very reluctant to add any new assets into the portfolio as the prices have been sort of coming back. And I'll probably be a little bit late before, in adding them as well, because I want to see the price structure start to change. But they are trading on like multiples to fees, even with the fee reductions from the drop off of activity, at sort of historic lows. So, I think that it all bodes very, very well. And, I think Bitcoin will lead the sector out.
And how's positioning in Bitcoin? I know you got a chart that I'm seeing on the chain about Bitcoin futures are subdued. Where are we with all of the market positioning, how short is the market going into this, or how kind of non-frothy is it? Have we unwound all of the excess leverage that was there?
Yeah, and it's unwound for really the last sort of 5 months. I mean, it peaked in December, and then since then it's actually been it's been coming down. So funding rates are extremely low. There's nothing there that suggests that the market is overpositioned at this point. I haven't looked at realized losses. That's a very good indicator for Bitcoin, and I don't have a chart on that. But in terms of just futures activity, the open interest has backed off. So open interest and funding rates are the two components of my derivatives risk score for Bitcoin. And I'm not sure if this is visible, but let me see if I can bring it up. Really what happened in Q1 of 2024 was an extreme reading for the derivatives risk score. But since then, actually, it's been fairly moderate. So,
I mean, how similar that is to the kind of 2021 period where you come into the year and then the whole thing just gets subdued for a period of time.
yeah,
Also, the one I look at a lot, what's not on here, is 2017, where I think there's a lot of similarities, but it feels that everything is unwound.
yeah. I mean, it almost feels like that move in 2024 was actually the most similar to the 2019 mid-cycle rally. They just went too far, too fast. Remember when it came off in 2018, at the end of 2018, Bitcoin bottomed, and by I think it was sort of April, so within like 5 months, the thing had 5x'd. And so the futures market was pretty immature back then. It was, BitMEX and maybe one or two others. But it's really the rate of change that scares, that it gets things, is when you should be most concerned. And the rate of change in terms of the open interest and funding rates at the back end of 2023 into 2024, when the ETFs launched, was very extreme. But at that point, again, we weren't in some sort of like massive bull market or the end of a bull market, and liquidity was actually tight. So, these readings I don't think are indicative of end of cycle readings. They are just the typical mid-cycle exuberance that happens with Bitcoin. And like the end of cycle readings you get only once liquidity has expanded considerably, and the Bitcoin price has obviously moved a lot.
What other charts should we look at?
I think the one thing I sort of wanted to just sort of bring everyone's attention to was perhaps just looking at where we are in terms of like rolling 4-year growth rates.
Oh, super interesting.
So this is another dashboard which we are looking to convert into a dashboard inside the RV platform, Raoul. And so all I've done here is I've aggregated smart contract platform on-chain data. So this includes around about sort of 40 or 50 blockchains, and looks at all the key performance indicators. And so things like daily active addresses, transaction fees, DEX volumes, the number of dApps that are generating fees, how many dApps are generating fees, and things like that. These are all data that we're looking at, and we're actually going to be building our own custom scores as well. And so if we look at the last sort of 6 months, we've seen quite a bit of activity destruction because of what's been happening. Daily active addresses are around 17 million as of today. They peaked at about 24 million around the time of the Trump and Melania coin mania. And so it says that it's off 8% here, but from the high, it's actually much higher. It's more like 25%, which is a big pullback in market activity, in number of active addresses.
And that's basically been the death of the meme coin market, or whether it's a death or the on life support system of the meme coin market.
Yeah, the sin binning of the meme coin market.
Yeah,
it shall return, I'm sure. Humans being humans.
Exactly.
But if you just look at the 4-year growth rates, this is where you sort of just distill the signal from the noise and look at how much the ecosystem grows year after year, whether it's a bull or bear market. So I've done it over 4 years because that tends to be the pattern. And we can see here that, that actually we've seen a large uptick in daily active addresses. We can see their relationship to price in terms of the correlations. And so we know that if these things continue to increase, then obviously prices will move with it. The big problem, again, coming back to what we were talking about earlier, is the lack of dispersion within the asset class. It moves with each other. And there's a reason for that. It's the immaturity of the asset class. But there are other factors which really pull down crypto assets performance, and that's largely to do with the tokenomics and the way that a lot of these assets come to market. And so we're in this sort of inflection point where activity is going to dramatically increase and regulations are going to start hopefully cleaning up a lot of the fuckery that's been happening with the way in which protocols disclose their supply, the tokenomics, the OTC deals that get done with market makers. That is really destroying confidence of the retail investor. So all these things sort of combined, I mean, I think the market and the outlook is very, very promising, because once we have rules, and I used to be very much an advocate for like, hey man, this is decentralized, just let the whole thing sort of like be its own thing and everyone will work it out. But in equities, we do have basic reporting which is required of all companies, and I think some sort of reporting logic that's enforced on protocols, if they're not sufficiently decentralized, where insiders control a large part of the supply, then they should be...
Which is most new tokens, right? It takes a long time to decentralize and distribute tokens.
Yeah. Yeah, and it gives them a pathway to decentralize. More onerous the requirements are for centralized tokens, hopefully, the faster they will want to decentralize. And that's what we're all here for, really. Yeah, so I mean, the other thing is just that I think that discrepancy between the value of smart contract platforms and the applications that sit upon them. So if you look at fees now, and if you delineate between the fees that are being generated by smart contract platforms and the fees that are being generated by DeFi protocols, on a daily basis, they're now about even. Now, that's a huge shift in the balance, because it used to be all generated on smart contract platforms. But as DeFi protocols have actually seen a real uptick in usage, they have actually started to accumulate as much fees as smart contract platforms.
And is that also because so much DeFi is on ETH, and so much of ETH fees have contracted because of the change in ETH and the layer twos?
That's it. I mean, yeah. So the dynamics for the ETH have had a huge impact on it, for sure. But it's also there have been, other ecosystems which have started to organically grow. And so that is also a large reason as well. But at the end of the day, activity within the crypto ecosystem is still highly concentrated amongst just a few platforms. And that's why there is this sort of large cap bias within the sector. I mean, you can have flash in the pan protocols that outperform for months and maybe even longer. But eventually, if the activity is not on that chain and the activity is not sustainable, i.e., the incentives that protocols will provide to draw users on, to draw developers on, if that doesn't stick over the long term, then that price performance fades really quickly.
And this is basically what I've always talked about when I talk about network activity and Metcalfe's law. This is a much more detailed way of establishing how vibrant is the network, how real is the activity, what's the longevity like, what's the growth like, because these are the things that drive price. We know that obviously global liquidity drives price, but the other thing is the network has to be valued, and network value is what drives the long-term secular trend above and beyond that of liquidity. This is the magic of why some cryptocurrencies do so well versus global liquidity. For example, we see that Bitcoin is almost like 8x the performance of the Nasdaq. And so the Nasdaq is 97.5% correlated to, or it has an R squared of 0.97 to global liquidity, and Bitcoin's 85. The reason it's 85 is because when you get to a bull market, it actually wildly outperforms because of this, which is the network adoption.
Yeah. So it's the juice. Like you can have an asset class rise, 'cause a rising tide lifts all ships, but actually where you get the outperformance is actually this thing is being used, which is just common sense. And so if you're not tracking that information and you're getting caught up on the narratives because of the KOLs that are sitting on Twitter just peppering, with all sorts of narrative-driven stories because they're being incentivized to do so, and you're not looking at the underlying fundamentals and just simply ranking. And look, on-chain data is flawed. If you look at any one of these metrics in isolation, it's not going to get you over the line because each one of these metrics now is also gamed by protocols. But at least what this dashboard is designed to do is actually say, hey, look, we understand all that, but let's just aggregate it and then look at the aggregate metrics versus the market cap of this space, and does it have signal? And so you do get these strong correlations. And so if you expect regulations and stablecoin growth and Web3 development, then the trajectory of the asset class is very clear.
Now, if you were to apply this framework to the major tokens, does it give you anything interesting? Like what is real and what is not that you see currently using the data?
Big part of it, that's a big research project that I've been working on. So what I can share is that firstly, you have to take this data, you have to clean it, you have to smooth it, and then you have to analyze it over many different time periods to then get a reliable indicator. And the reason for that is what I just mentioned about incentive-driven campaigns. So look, I'll single out one blockchain right now, and it's not to accuse them of doing anything that other blockchains don't do. And it's not to say also that this activity will not stick. But if you just look at Sonic, which is the revamped Phantom chain, right? So they've had a rebranding and they
were on Real Vision yesterday, I think.
Yeah. And so they are doing what ideally, what most blockchains will always do is they'll try to bring new developers on. They've got a new consensus model, and so the throughput on the chain is a lot faster. Now, they are seeing a huge uptick in daily active addresses. They've outperformed in addresses, fees, transaction because activity is coming on chain. So that's great. We saw that with Sui last year. We see that with every single chain. So the point is that unless you're trying to trade on the short term, we need to, in order to get reliable sort of on-chain indicators, we need to zoom out and sort of look across multiple time periods because that 1 month rise could very well evaporate in 3 months.
How long a time period do you think we need to figure out what's real and what's not? What's incentivization? I mean, look, there's incentivization everywhere. That's the point of blockchain is you can use incentive systems. But how long do you need before you can tell whether it sticks?
I think about a year, because there's a limit to the amount of there's a limit to the incentive programs, and they're running down their treasury by doing so. They're also increasing the circulating supply. So these campaigns tend to be months, not years, and not even close to years. So what I've noticed with Sui is that they've had a couple of these events, but after the incentives slow down or stop, that the level of usage is a step higher afterwards. Right? So it's sticky around. Yeah. Network effects are being created. They're spending to do it initially, but it's only working because they have a chain which has advantages or features that developers want to build on. And so, rather than sort of get into the nuances of, parallelization or the reasons why this chain is slightly faster and slightly better, I tend to look at the data and the sustainability of the activity data to try and get some metric.
Because everything else is narrative.
And it also means, it gets narrative, and it means that it doesn't necessarily identify, very early. But I think this is at least for me personally, I don't know about you, it's risky enough being exposed to the asset class. Like I don't need to try and pick the out of the box, outperformer of the cycle. It's just makes sense to actually just be exposed to the assets that have the network effects, and they should do fine over time.
Any other blockchains that stand out? And and in addition, the corollary to that is Ethereum and what your views are.
Well, I mean, we haven't had it in the RV portfolio for very good reason. The technicals,
it's been a dog with fleas.
like catching a falling knife. I am of the view, though, that actually it outperforms going forward. But I've been saying that for 3 to 6 months. But I've also not been prepared to put any money behind it as well. Like it's an interest. Everything that's happening with Ethereum right now is causing the kind of friction or discussion that the protocol needs in order to improve and to accelerate. So I think they will eventually work it out. But as an investor, if I look at that chart, there's no fucking way. So until it actually starts to outperform other assets, I think we can leave it alone. It's also very hard to fundamentally evaluate Ethereum because
it used to be easy. It used to be the easiest.
Yes. Layer 2s add so much complexity. And so you can't really quantify the siphoning of value away. But if there is a recalibration of fees, or if base rollups really take off and more of that value flows back to the base chain, then it will change the value proposition.
My mental model for ETH is that they've built, because of the layer 2s, massive redundancy in how much the chain can be used. And because of how the fees have been allocated, it makes it look particularly bad. Do you track the overall volumes of the EVM system and see what that looks like? Or, and my guess is the overall volumes aren't suffering. It's just the fee layers suffering.
Yeah.
And it just means that we need more activity in ETH because it's so big now and its capability is so vast that you just need a shit ton of activity, like the financial system.
Yeah. So EVM as like an ecosystem, or as like a subgroup, has been performing extremely well. So I mean, if you look at sort of like Say, which is a sort of an up and coming sort of generation 3 blockchain, it decided to use the EVM but improve upon it, use parallelization, and use a different coding programming language as well. But it's essentially using the EVM because it recognizes the network effects that it has. So the EVM ecosystem is robust and growing, and we're seeing more L2s being added all the time. So yeah, I mean, from that standpoint, it's very hard to displace the EVM as the central hub for all of the crypto economy. And yeah, I agree. Like as we see TradFi start to work inside Web3, they will go to Ethereum first and test and trial on the base chain, and then create or spin up their own L2s. And we've already got examples of that with Robinhood and Arbitrum. Sony, which has been a failure by all accounts, but we shouldn't have expected anything else from our friends in Japan when they do these sorts of things. It's always somehow misguided. But yeah, so Ethereum will be the natural home for a lot of activity.
Yeah, my view is, the any bank you've ever worked in or ever gone into, there is not a single Apple Mac. It is all Microsoft everywhere. And it's the same with EVM. You won't get fired for it. So that's my view, is like they've now overbuilt capacity, and once the financial system kind of uses Ethereum overall, it brings enough activity because finance is like the big daddy of almost all activity on chain. Anything else that interests you or makes you hold your nose and go, this stinks?
Well,
Where you think
I'm
narrative might be wrong versus the reality, or subsectors, if you want to name a token.
well, yeah, I've started to really look at this whole pullback has given an opportunity to really dive a little bit deeper into some of the DeFi protocols, because this is naturally where all the activity is going to take place. If we are hopefully moving more away from the crypto casino into a world where traditional financial players start to use blockchain rails, and if there's tokenization of financial assets inside on blockchain rails, then I think some of these DeFi protocols stand to sort of win based on that new activity, but also based on the valuation discount that they currently experience versus blockchains. And again, I think it'll be a concentration of DeFi protocols which will capture most of that value. So look, we haven't come out with anything for pro crypto about this in terms of like specific ideas, but there's definitely protocols. If you look at, on base, you've got Aerodrome, which is capturing lion's share of all DEX volume there. You've got Uniswap, which is, everyone is most hated DeFi protocol just in terms of like the price action, which should do very, very well. And once they sort out like their fee switch and sort of value accrual model. Athena looks especially interesting, but there is some risks there in their model. As a stablecoin play, in the way that they're starting to work more with traditional players, maybe even Ondo, because of their relationships with some of I think it's BlackRock or maybe some of the other traditional finance players. So I think that space is one to watch as we sort of, approach the second half of the year.
What about Hyperliquid that everyone talks about?
Sorry, what's that?
What about Hyperliquid that everybody talks about? Is that something that you're looking at?
Yeah, it's the data providers that I use haven't been as good in getting the data feeds for it yet, but it is something that I'm looking at. I think the app chain thesis will continue to strengthen, where Uniswap are doing it now, so it's like no better sort of indication that that's where the space will eventually go, I believe, to some degree. So Uniswap probably operate multi-chain, but will try to capture as much of the EVM activity via its own chain. But with Hyperliquid, they've just had an issue with, I think it was a hack, or there was a compromise last week, and it was quickly recognized that the thing isn't that decentralized, the way that they covered the losses. So you've still got a lot of embedded risks in the ecosystem, a lot of these protocols. But yeah, I think I know that like the Hyperliquid UI is been really well received in the marketplace, and it's gone from nowhere to the large share of perps volume within just a 6 to 12 month period. I don't know what's going to happen post this security breach. But yeah, it's definitely on my radar.
So to sum up your views, give me your time frame for the bottoming of the market in this kind of crappy price action we're seeing today, and then what does it look like? What is your potential focus for the kind of 6 months after that? Like where would you look to place your bets?
So I think we'll sort this bottom out in the next 3 to 4 weeks. And
is it much lower in price or sideways chop? And
I would be really surprised if Bitcoin trades lower than sort of mid 70s, which is nothing from here. If you look at the consolidation pullback that we saw in the middle of last year, there's so much volume that built up in that range that I don't really see Bitcoin breaking much below that.
And we've had 7 of these corrections since the bottom. And the last cycle we had 5 in the last year of the cycle. And sorry, the one I look at a lot is 2017. We had 5 of them that were all like 30% plus. So
we're all petulant children. Like we're just never happy. even though this asset class is like delivering and delivering over the long term, or at least Bitcoin is anyway.
Yeah. And then, so, okay, so we bottom over the next 3 weeks, 4 weeks, probably more sideways than sharp down. Obviously, alts probably still continue to bleed for that period of time because Bitcoin needs to establish itself, reestablish itself. Coming out the other side, we've got a lot of discounted stuff. DeFi is one of the areas that's kind of front and center for you. Anything?
Yeah, because it has the fees, it has the uses. So if the thesis is right, then DeFi should do really well, and it's the only sector or any sort of DApp sector that's really gained traction so far.
Do fees matter in speculative phases? Or is it a disadvantage? It's kind of an advantage over a long-term value accrual, but often anything you can't value, like brand new protocols or memes or whatever, tend to outperform in the periods of market kind of euphoria.
Yeah, and that'll happen again. And that'll be, I will be less inclined to be taking punts on some of the new launches that come in towards the end of the cycle because they're unproven. There's all sorts of, for all the reasons that I've, like we talked about earlier, about the way that these things launch. And you're, as a retail investor buying after TGE, you just have no fucking clue of what games are being played with the market makers. How much of the lock supply has been lent out to market makers, which is a regular occurrence, and that needs to be cleaned up. And also the fact that they are just unwilling to launch these things at reasonable valuations. Can you imagine back in the day, like if you were an investment bank and you were working on these IPOs as one of the syndicate banks, and you had a record of like every single IPO down 3 months later after launch, like you would not get any more business. But
yeah, I mean, I look at it in another way: is take that as accepted, and what you tend to get is every one of these falls 70% after launch.
Yeah.
And then that's when you got to do your work.
Unless you're in
this
a
interesting?
And it will rip.
Yeah, because if it's interesting and you buy it down 70% for its first correction, or 80%, whatever the number is, that's when you can make some real money if you get something that has real activity and catches a narrative. Yeah. So the best thing is don't buy these things on launch.
Yeah, it's a crapshoot, total crapshoot. But I think, we grow. I still have a view that we get to about 6 to 7 trillion. This in terms of total market cap of the top 200, which is the index I use. Within this cycle, I think that we've really seen this cycle getting pushed out. I was of the view it was end of this year. It looked like it has to be next year, and just because of the amount of I guess the degree of the growth shock and the level of liquidity that will be now required to shore up the treasury market, which we didn't really talk about, but like if tariffs are being levied and there is a fall in exports overall, then there is less money recycled into treasuries. And so I think that is just another impetus for the Federal Reserve to come kicking and screaming to the party, the way that Besant
and Trump. If you listen to Trump and Besant and everybody, they're like, first get the dollar down, get rates down, get oil down, get the tariffs done, get some tax revenues coming in from that, maybe give them out to some people, the bottom 50%, whatever it is that they do with this. And then it's about growth because they need the economy growing. And Besant has been really clear about this. Is like, we need Main Street to be making money again. And the issue has been rates have been too damn high. And they need to get the ISM through 50 and accelerating higher, which is the classic sign of the next phase of the cycle, which is when liquidity is really happening, the business cycle's happening, earnings get recycled, people start taking risk. That all lies ahead. But because the ISM is still bottoming, which is unbelievable, it's the longest bottoming pattern, I think, in the history of the ISM now, it kind of almost certainly pushes the cycle into 2026.
Yeah.
Which means we've got 12 months ahead of us. Because people, I think mentally in their heads are like, oh, well, I want to start getting out by October because, and so they keep getting worried we're not going to make the price returns. But we got a year to make price returns. And the last year of a bull market, we've often seen 2, 3, 4, 500% returns.
Yeah. And look, there's midterms too. Like,
that's right. They want to
Trump
go
is
to
a
the midterms
political
strong.
beast. He needs to get growth ripping by the end of this year. So as you sort of go into the midterms, which could really like influence his agenda for the second part of his term. So I think that bodes well for liquidity and for ISM above 50 and for asset prices.
Fantastic. Jamie, thank you as ever for A, getting up early in Australia, B, sharing the massive depth of your knowledge, and for anybody interested in what Jamie does, his dashboards some of the dashboards are in Real Vision Plus, also in Real Vision Pro, and he is in Pro Crypto, and he's a true pro at this, and always grateful to have you on, Jamie. Good to see you, my friend.
Yeah, thanks very much, mate.
And let's see if you're the lucky charm this time, like you were last time, that the bottom pretty much comes in the next weeks, 2 or 3 weeks from this. I kind of think it will.
Pencil it in for October.
The next time everyone's panicking in a market drawdown. Okay,
yeah, exactly.
We got that. We got it ready. All right, mate. Thank you, everybody. We'll see you next time. And I might put something out myself on some more analysis later in the week, whether it's on Real Vision Pro or for the broader audience. But we're here to help.
Thanks, Raoul.
SuperAI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that all in one place in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world.